If you are a freelancer, a contractor, or anyone who gets paid without taxes being withheld, stop scrolling right now and watch every single second of this video. Because what is happening in 2026 is not something you can afford to ignore for another day. The IRS is currently running the most aggressive enforcement campaign targeting self-employed people that this country has seen in over a decade. They have billions in new funding. They have thousands of freshly hired agents. And they have artificial intelligence systems that can scan your entire tax return, cross-reference it against your bank activity, your payment apps, your 1099s, and your prior year filings, and flag every single inconsistency in seconds. This is not the slow, understaffed IRS that people used to joke about. This is a completely different animal. And freelancers are the #1 target. Not Wall Street. Not big corporations. You. The person invoicing clients. The person getting paid through Venmo, PayPal, Stripe, and direct deposit. The mistakes getting people audited right now are not complicated schemes. They are simple, everyday errors that thousands of hardworking freelancers are making without even realizing it. By the end of this video, you're going to know exactly what every one of those mistakes is and the exact steps you need to take right now to make sure your return is clean, protected, and audit-proof. Do not click away. This one could save you thousands. Let's get straight into it. Mistake number 1, treating your tax bill like a surprise at the end of the year. When you work a traditional job, your employer withholds taxes from every single paycheck automatically. You never have to think about it. But the moment you go freelance, that system is completely gone. Nobody is setting money aside for you. Nobody is sending payments to the IRS on your behalf. That is now entirely your responsibility. The IRS expects you to pay quarterly estimated taxes 4 times a year: April, June, September, and January. If you miss those deadlines or consistently underpay, you are not just going to owe a lump sum at tax time. You are going to owe that lump sum plus an underpayment penalty that has been quietly stacking up the entire year. And when April arrives, and you suddenly realize you owe $10,000, you never set aside. That is a financial emergency, a completely preventable one. The fix is simple. Every single time a client pays you, immediately transfer 25 to 30% of that payment into a separate savings account. Do not touch it. Do not rationalize spending it. That money is already spoken for, and the sooner you treat it that way, the safer your financial life becomes. Mistake number 2, deducting personal expenses as business expenses. I hear versions of this constantly. I use my car sometimes for client meetings, so I wrote off the whole thing. I bought a new phone that I mostly use personally, but I claimed it as a business expense. Listen, the IRS has seen every version of this move, and their auditors are specifically trained to catch it. When you deduct personal costs as business expenses, you are not being savvy. You are building a paper trail that collapses the moment anyone looks at it closely. And the consequences go far beyond just losing that deduction. You can face accuracy-related penalties of 20% on top of the additional taxes owed, plus interest running from the original due date. Only deduct what is genuinely and legitimately used for your business. If something is used for both personal and business purposes, like a phone or a laptop, deduct only the actual business use percentage and keep documentation showing exactly how you calculated that number. Mistake number 3, completely ignoring self-employment tax. This is the one that genuinely blindsides people when they find out about it for the first time. When you are a regular employee, Social Security and Medicare taxes are split right down the middle between you and your employer. Each side pays 7.65%. But when you are self-employed, you are playing both roles simultaneously. That means you are responsible for the full 15.3% on your net self-employment income. And that is on top of your regular federal income tax and your state income tax. When freelancers see their real tax bill for the first time and realize how much of it is purely self-employment tax, the shock is real. You can deduct half of it when calculating your adjusted gross income, which helps. But you need to know this exists. Build it into your savings rate from day one, and never let it sneak up on you at filing time. Mistake number 4, waiting until tax season to think about records. Documentation cannot be reconstructed after the fact. If the IRS audits your return and asks you to prove $15,000 in deductions from 2 years ago, and you cannot produce receipts, invoices, or bank records, those deductions are dead. It does not matter that the expenses were real. Without proof, the IRS disallows them entirely, and you owe taxes on money you already spent long ago. Keep all tax-related records for a minimum of 3 years from your filing date. Every receipt, every invoice, every client contract, every business-related bank statement, organized and saved somewhere you can actually find it. Use a cloud storage folder, use an accounting app, use whatever system works for you. But record expenses as they happen, not in a last-minute panic every April. Mistake number 5, going it alone when your situation calls for a professional. So many freelancers say they will hire an accountant once they start making more money, but that thinking is costing them right now. A qualified CPA or enrolled agent who specializes in self-employed clients will almost always find legal strategies that save you more than their entire fee. A. SEPI, RA, or Solo 4O. 1K contribution that dramatically lowers your taxable income. The qualified business income deduction that can allow eligible freelancers to deduct up to 20% of qualified business income. Strategic timing of income and expenses to manage your tax bracket from year to year. These are not tricks or loopholes. They are tools that exist specifically for people like you. And a professional knows how to use them correctly while keeping your return clean and defensible. Here is the bottom line. The IRS in 2026 is not the same agency it was 5 years ago. It is smarter, better funded, and fully focused on self-employed filers. But none of this has to touch you if you stay organized, report accurately, pay your estimates on time, and get the right help in your corner. The freelancers who handle their taxes with intention are the ones who never have to feel that gut-dropping panic of an unexpected IRS letter. Get ahead of this right now. Not next month, not at tax time. Now. If this video helped you, smash that like button and subscribe for more content that protects your money and keeps your business growing. Share this with a freelancer who needs to hear it. I'll see you in the next one. Next.